Welcome to Capital Insights. Thanks so much for being with us today. I'd like to talk a little bit about interest rates and the Fed. What are they going to do? You know, kind of a very important topic, not only for 2015, but really as we look back over the last 35 years. I mean, you know this. In 1980, we had double-digit interest rates, almost near 20%. And 35 years later, we find ourselves at just about zero on interest rate levels. What that's really meant over this period of time is that credit expansion and interest rates dropping, driving credit expansion, has been a big key underpinning to the U.S. economy. So as we sit here today in 2015, we know that the Federal Reserve is contemplating raising interest rates. It has now been, or it will be in September of this year, 7 years that we've been at 0% interest rates. It's been the longest, if you will, Federal Reserve monetary experiment in the history of this country, and very meaningful. And meaningful also to the financial markets. In fact, you know this year we've had a little bit of heightened volatility in the financial markets. Why? What we think is occurring is that the market is adjusting to or trying to price in that interest rate increase that we all know is coming. In fact, in February of this year, we saw a high in both the utility sector and the REITs, which are big, yield-oriented equity sectors. Since that time, the utilities are down almost 15%. Since that time, the REITs are down about 10%. That's a lot. But again, these are two income-oriented, bond substitute-oriented sectors that are struggling to price in what's going to happen when the Fed raises rates. So as we look at what the Fed has been saying this year, they've been talking about raising rates. Earlier on, they were talking about June. Now they're talking about potentially pushing that off a little later. But the problem is, at least over the recent past, we've run into some weakness, some economic weakness. We wrote about this in our February monthly discussion. We wrote about the Atlanta Fed's GDP Now model, it's called. The Atlanta Fed has come out with a new model this year that purports to forecast GDP. What it does is it takes the 13 components of GDP that the Bureau of Economic Analysis uses, and it updates them on a real-time basis. In fact, for the first quarter of this year, that model was predicting 0.1% increase in GDP. And this was occurring while the blue chip economists were predicting 1.5 to 1.75%. The actual number came in at 0.2%. The Atlanta GDP model was very, very close. And in fact, we've had some data come out after the first quarter that tells us that the first revision to first quarter GDP in the United States this year is going to be negative. We're going to watch a negative print when we see that first revision come. So the question again comes, how can the Fed raise rates if we're looking at potentially negative GDP? Even more so, we're filming this today on a day when the non-farm payrolls have been reported for May. The market's up almost 300 points today. Why is that? It's up today because the number was lower than expected. It was weaker than expected. And what investors are thinking is that with that economic weakness, that's going to force the Fed to raise rates later, not sooner. It's not going to happen in June. It's not going to happen in July. Maybe it won't even happen in September if these numbers, if this economic softness continues. Well, is that really true? We think the Fed is in, if you will, the grips of a little bit of a dilemma. And it's a meaningful dilemma. And it's a dilemma that they'll never speak about publicly, but that we need to think about and incorporate into our investment decision-making and actions over time. And this is what it's really all about. If we think about the current economic cycle, in June of this year, even though it may not feel like it, we are 6 years into this economic recovery, this current recovery. That just happens to be the fourth longest economic recovery since 1945, and there have been 11 economic recoveries. So that's no small feat. 6 years, that's a long time. In September of this year, we'll now be 7 years into the Federal Reserve having held interest rates at zero. You'll remember back in the fall and winter of 2008, the Fed embarked on zero interest rates as a crisis measure. We were in the grips of a massive economic downturn that we hadn't seen probably in our lifetimes. It was an emergency response. Well, 7 years later, we still have this emergency response. And again, we've never seen anything like this at all. And the reason, again, it's so important to investors is that over this period of time, from late 2008 until now, not only has the U.S. government borrowed another $10 trillion, and we only started with $8 trillion back in the fourth quarter of '08, but the Federal Reserve has printed almost $4 trillion and used it to, if you will, buy back bonds and inject that liquidity into the markets. So it's no wonder investors are very, if you will, concerned over trying to price in what will ultimately be the change in the cost of credit in the U.S. credit system. That's what the first Fed rate increase is really all about. But again, this kind of exemplifies to us the Fed's dilemma. Remember, that 0.2% GDP number for the first quarter? Well, for the second quarter, the Atlanta Fed model is now predicting about 0.8%. That's a little bit better than the first quarter, but it isn't all that hot, especially relative to historical perspective. And again, can the Fed actually raise rates when the economy is this slow? Well, here's their issue. If we go back and look at history, and we look at the Fed funds rate, it's called, this is the interest rate that the Federal Reserve controls. So when you hear, oh, the Fed didn't raise rates today or lower rates today, we're talking about the Fed funds rate. Equate that, if you will, to money market fund rates. It's a very short-term interest rate. So here's the dilemma. In every economic recession of the last 6 decades, the Fed has lowered interest rates. They've lowered interest rates to try to stimulate the economy. They've lowered interest rates to try to ameliorate a market downturn, etc. Every single recession, there are no exceptions. You can see the punchline coming, can't you? How do you lower interest rates from 0? And the answer is you don't. So the dilemma that the Fed is facing 6 years into this economic recovery, and this 0.2% GDP number in the first quarter of this year is reminding us that the economy is cyclical. It's reminding us that the economy doesn't go straight up every quarter. It's reminding us that recessions are a reality of really all global economies. So the issue that the Fed is facing is one of time. We're drawing ever closer to the next recession. Do we think that's coming right away? Well, we don't see it on the near-term horizon. It's not coming in the next 2 months or 3 months. But we're seeing a lot of anecdotal evidence of slowing. So the Fed's real problem is they cannot be caught at 0% interest rates when the next recession arrives. And the clock is ticking 6 years into this economic recovery. So even though on a day like today, the non-farm payroll numbers aren't all that great, the market's celebrating the fact that the Fed can't raise rates right away. Well, it's somewhat ironic because the Fed is running out of time. It's going to need to raise interest rates before the next recession comes. And this may sound like a wild comment, but they need to raise rates to be able to ultimately lower them in the next recession. If they don't do that, and they're caught at 0% interest rates when the next recession arrives, the Fed will be powerless to help the U.S. economy. Can it print money again? Sure it could. But after printing $4 trillion, we have a 0.2% GDP number in the first quarter of this year. Printing $4 trillion didn't return us to any type of 3 or 4% GDP growth rate. So the Fed already knows that's ineffective. Could the Fed try to move toward negative interest rates in the United States like we've seen in Europe? Well, one of the real problems that we still have in the United States is underfunded pension plans, underfunded entitlements, both at the government levels and at the private sector level too. The last thing the pension fund industry in this country needs is negative interest rates and trying to scramble for rate of return that they're going to need to fund pensions over time. So it's very much a dilemma. And our thoughts right here is that regardless of what happens to the tone of the economy over the next few quarters, the Fed is going to have to raise interest rates. They're going to have to start. Again, regardless of whether they want to or not, because of GDP numbers or other economic numbers that may be soft, they're going to have to start to raise rates. It may not be in June, but it's a really good bet that somewhere before the end of this year, and it's probably coming in the late third quarter or fourth quarter, the Fed's going to have to embark on this. Because again, I can see it now. I can see the headlines in the Wall Street Journal. Economy enters next recession. Fed says good luck. We already have rates at 0. There's nothing we can do. That can't happen. The Fed can't allow that to happen. Otherwise, they risk losing credibility among financial markets, among investors, etc. And that wouldn't be a good thing, because so much of this market is built on trust in the Fed over the last 5 years. Things aren't going well, they'll lower rates. Things aren't going well, they'll print more money. Bad economic number today? Don't worry, the Fed won't raise rates. It all kind of comes back to the Fed. So, as you listen to all the controversy regarding the Fed, regarding interest rates in the months ahead, and you look at these economic numbers, just remember that the Fed cannot be caught at the zero bound, 0% interest rates when the next recession arrives. They're running out of time. They're fully aware of that. They'll never speak of this publicly, but those interest rate increases are coming. Do we expect them to be moonshots and interest rates to go up to 3, 4, 5%? Of course not. The Fed's going to move very, very, very slow, but it's very meaningful to our investment activities and behavior because, again, this represents the repricing upward of the cost of credit in the U.S. economy. Very, very important. We'll be monitoring and discussing this as we move ahead. On behalf of the entire team at Capital Planning Advisors, thanks so much for your time and being with us. We very much appreciate it. I'm Brian Pretti.